Thank you all for coming. We are glad to have you today with us at our Center for Economic Policy at the Hong Kong University of Science and Technology. Today, we are going to be talking about cryptocurrencies, blockchains, and the digital economy with this wonderful panel of experts. So let me present them. So we have Christine Parlour, Professor of Finance and Accounting at the Haas Business School at the University of California, Berkeley. Also has Ben El-Baz, Head of Ecosystems at HashKey Group. We have also Anthony Lee Zhang, Professor of Finance at the University of Chicago Booth School of Business, and Yanzhen Chen, Professor at the Hong Kong University of Science and Technology Business School of Information Systems. So the talk today, we will have a 1 hour panel discussion in which I will be asking questions to our experts, and then we will have 30 minutes of Q&A from the public. So feel free to write your questions on the Q&A chat that you should find below on the Zoom application, and we will read your questions during the last 30 minutes. So without further delays, I will start with the first question, which I guess I can ask to Christine, but then all the panelists feel free to jump in, and is what are cryptocurrencies and crypto assets? What makes them special? Why are we talking about them?
I think there are two things, or there are many things that make them special, but the ones that I would point to are the following. One, tokenizing things and these sorts of digital assets allow you to basically take things beyond cash flows and trade them. So you can trade incentives, you can trade all sorts of other stuff, which is sort of economically new. The other thing that's useful about them, and it was sort of embedded in the previous sentence, is that you can trade them. The claims are liquid. Yeah, I mean, there are going to be some smaller tokens that are illiquid, but generally they are liquid. And while there are some situations where you want claims to be illiquid, the fact that they're liquid actually adds quite a bit of value.
Another thing that seems to be special about the crypto assets, right, is that they are built on the blockchain, many of them, right? So I will ask Yanzhen, could you explain us what makes the blockchain work, or what are the, yeah.
Sure thing. The blockchain is actually, it's linked blocks, and each the block consists of a list of transactions. We link the blocks using some cryptographic construct, something we call the hash function, so that if any record in the block got changed or removed, we will immediately tell that the transaction has been modified.
So then coming back, I guess, together with what Christine was mentioning about being able to tokenize these cash flows and sell them and make them more liquid, right? How does the blockchain help us achieve this compared to, say, like other traditional financial products that may have existed before blockchains or distributed technologies? Maybe, Ben, you may want to answer this question.
Yeah, no, I think it's a question you hear a lot out there, right? You know, everyone hypes up the technology. You know, is it really better than the status quo? What's good about it? And I think there's been a lot of experimentation over what is it, 2022 now? Let's see, starting from 2015, 2016, right? So it was about 6 to 7 years of different types of experimentation with what blockchain can do well and what it can't do. And I think we've seen in the market basically two approaches, right? You have the permissioned private chain approach, and then you have the permissionless public chain approach. And I mean, basically, this is just kind of my opinion and viewpoint on the space, right? Like, I think the original kind of promise or rationale with why a blockchain database could be preferential is because in theory you should be reducing the cost of verification of transactions, right? So maybe in like a normal database, because it is because you maybe potentially have siloed databases between multiple different parties, the cost of reconciliation is high, right? This guy has this database, someone else has a different database, do the versions match, do the balances match, and then there's a lot of transaction costs associated with that. So that was kind of the what really people were excited about Bitcoin, and then Ethereum came, and Ethereum's public. The challenge with the Ethereum approach was that it didn't scale. You had 10 to 20 different 10 to 20 TPS transactions per second. So and that's just the nature of the fact that like all the databases have to run all the transactions, right? So it's just it's a little bit cumbersome. So that led to the approach of different private blockchains where they're permissioned, and the scalability could be a bit higher. The only challenge with the kind of the permissioned blockchains is a lot of those projects and use cases haven't really scaled up because they're kind of closed loop ecosystems. So I think maybe just wrapping this up, I think my summary thinking on this is like blockchain is a good approach to use to reduce the cost of verification for some type of business model, right? But you have to really kind of look at the details in terms of what chain is being used and that, and there's a bunch of different use cases that have been experimented with.
So in terms of the use cases, I guess the perfect question for Anthony will be, what are the type of applications? So we have heard about DeFi, decentralized finance, we have heard about NFTs. What are the most common applications, or the ones that you think are more relevant?
Thanks, yeah. So maybe I'll sort of add a tiny bit. I agree basically with everything that was said about blockchains and sort of what are the fundamentals and what's kind of special, but maybe I'll add an extra thing on top of that and also point to use cases. So I feel like a feature of blockchains, I think that makes them kind of special, is sort of consensus enforced by sort of a minor incentive model, as opposed to sort of a centralized power that basically keeps records and has the discretion to change them and weak incentives not to change them. So what do I mean by this? Suppose you are an exchange or a government, right? Say you're an exchange keeping records of who owns what, or you're a government keeping records of who owns what house, right? And the idea is that ultimately sort of the only thing preventing you from saying like, now Marc doesn't own his house, like now I own the house, is that you have a reputational concern there, right? And I feel like one of the magical features of blockchain technologies is creating this kind of mining system where miners have an incentive, basically, when they're small, to take correct transactions with correct signatures and kind of put them into the chain, correct smart contract operations, put them into the chain, but it's sort of decentralized enough that no miner has a very strong incentive to do anything, has much capability to do anything other than naively put transactions in the chain, right? So it accomplishes a kind of record-keeping function with, I think, sort of much more limitations on the ability of the centralized authority to go in this system and say, now Marc doesn't own his house, right? And I think sort of you then see the kinds of systems for record keeping that previously have been the prerogative of governments and courts, starting to emerge in the blockchain space. So what can you, for example, do, right? You can sort of claim like tokens that society thinks represents like pictures of monkeys, right? Or you can write basically contracts saying basically, I'm going to pay Marc whatever the Ethereum price is at some point in time, like a perpetual derivative, right? Or we can do lending transactions, we can do sort of borrowing transaction trade, stuff like that, right? So really, I feel like you're seeing a bunch of stuff that we had done in traditional financial markets, trade stuff, lend stuff, make bets on stuff, basically financial derivatives, right? But instead of a channel through which basically we write this in a paper contract, and the paper contract is enforced by a court, where the judge and sort of the court system ultimately has discretion. It's if they want to honor the contract is honored. Instead, this is routed through code, where we write 3 lines of code, and then me and say Yanzhen have a code agreement, and sort of neither of us really has any discretion. The miners naively execute what goes on the code, and then that executes the derivative, the lending transaction, so on. So I mean, it's a giant space, but I feel like the applications that I'm kind of excited about are the DeFi kind of lending, derivatives, trading, attempting to construct algorithmic stablecoins that are backed by nothing and for some time work. And sort of these are the kind of applications we're seeing so far. Sorry for the slightly long-winded answer on that.
So you just touched on a lot of interesting topics. And I guess regarding stablecoins, I guess there will be many questions during the Q&A today, given the recent events with Terra Luna, right? So I guess one issue that I wanted kind of like to follow with is like this permissionless or like decentralized trust that crypto is bringing us, right? So I guess the question I have is, do we really need such a strong decentralization, right? So the court system in countries like, for example, the US seems to be more or less working, right, on enforcing the contracts. So why do we need even more decentralization? Right. So maybe this question I can ask it to Christine.
I was afraid you would do that. So I think that's actually a really tricky question to ask to anyone who's got an economics background, because we think as a benchmark, the social planner who basically has no constraints is going to get us to where we should be. And in terms of the real world, what would that mean? That would mean basically, Goldman Sachs controls everything and they allocate resources. Whether or not we as sort of individuals who live in a society would be happy with that, that's a different question, which is where the sort of idea that, oh, we could do it without an intermediary comes in, which is where we get to sort of decentralization. I think there's a sort of a very strong difference between things that are economically efficient and things that are perhaps, let me call them socially efficient. And those two exist side by side. Those two concepts exist side by side. And they're probably two measures that we should use to evaluate whether or not any particular blockchain application is working well. Just on just a sort of a quick follow-up to Anthony's set of interests, I'd also sort of like to flag some of the permissioned blockchain, essentially information sharing agreements that seem to be working quite successfully on the enterprise level. So JP Morgan and the sort of link, which is essentially sharing a ledger. There's, USD Forward, which is small consortia of banks that are essentially have a bank-specific stablecoin that they're trading among themselves. Finality, that is sort of looking to do a universal settlement coin. So I think there are a lot of interesting use cases that potentially will reduce the cost of payments and step around the correspondent banking system, which could be a source of global efficiency.
So I guess I will ask also Yanzhen, what is your view of, or if you wanted to add anything about the applications?
Yeah, I think related to what Christine just commented, it's the applications between public chains and permission-based chains, and the right balance interaction between them could be very interesting. Especially, for example, central banks, they dislike decentralized money like Bitcoin because they can't control the supply of it. And it also threats the sovereignty of their own national currencies. Hence, numerous central banks around the world, from countries such as China, Sweden, South Africa, and also the European Union's the ECB. I mean, they are working on their own state-issued CBDC, and this CBDC is a digitalized version of domestic currency that's equal to the physical cash that we use, or reserves that your commercial bank holds at a central bank. But how does central bank and commercial bank, how do they work together in launching CBDC? That could be another interesting application.
Thank you, Yanzhen. So now I wanted to come to Ben with two questions. First one will be from the industry perspective that you have. What are the applications that you think are more interesting? And then also I wanted to pick on something that you started talking about, that is the scalability problem, right? So I guess maybe if you can talk about these two topics. And
Sure. Yeah, great. No, I think this year and last year has been an incredibly exciting time to be, to be in this industry, right? There's been, I think as Christine mentioned, there's still ongoing innovation with a lot of the traditional institutions in terms of exploring how blockchain can be used as a consortium platform for data sharing and information sharing. So that's continuing to go on. And a lot of I think more recently, like a lot of the action around that has been in CBDCs and central bank digital currencies, and then how could multiple different ledgers of different countries kind of combine and integrate with each other. So that's on that side of things. In addition, right, in the application space, I do still think it's important to highlight like a lot of the, I would say it's kind of experimental, and some of it can look crazy at sometimes, but there's extremely high amount of innovation that's happening kind of in the kind of the pure crypto area, right? Everything around decentralized finance, and you could say that some things are a little bit Wild West, some things might need to be regulated over time, but there's still a lot of interesting uses of the technology for a lot of these different types of financial instruments, right? So I'll come back to that in a short moment. There's a lot of interesting applications around around gaming and virtual reality and all kind of these like virtual digital economies. How you could potentially take the model of internet gaming platforms and take these traditional Web 2.0 business models and kind of turn them on their head and say, well, what if instead of, this is the Center for Economic Policy, hosting this chat, right? Like, if you look back, and I think panelists from Berkeley Haas would appreciate this reference, right? I think one of my favorite books from the old internet era was a book written by Hal Varian and Carl Shapiro out of Berkeley, Information Rules, right? I think written in like 2001 or 1999, where they really kind of looked at Microsoft's strategy and kind of the strategies of the kind of the first internet era, right? And from that, right, you had these concepts of lock-in, and in order to really capture value from internet users, right, you should have this concept of lock-in, right? So kind of lock in assets, and don't let users kind of take things that they've earned from the platform and move them out of it, right? So in the case of Facebook, that's something like your digital identity, right? Your Facebook ID can only kind of be used in the Facebook ecosystem. In other types of gaming platforms, right, traditionally it's like you earn the in-game items and you can use that in that economy. What blockchain has started to open up is the possibility of transferability of assets, right? I think that was mentioned earlier in this panel as well, which is that if in a particular platform, let's say it is let's just say it's a social media platform, your identity, like the rights over to your username, generally speaking, that's not transferable. But there are some experimentation with social networks where your blockchain wallet address, like your Ethereum blockchain address, is your ID, and that can be used on social platform A, social platform B, social platform C, and you actually own that, right? In the case of gaming, right, those assets that you earn in the game, they're actually on-chain assets, whether they're NFTs or other things that can be kind of transferred across different areas. So a lot of exciting things happening that are use cases of the technology that are starting to enable new and exciting different types of business models, right? So I think that's what's exciting to me. And maybe just hitting on one last point before letting other speak on other questions. I think the question previously about disintermediation versus intermediation, I think one of the key areas there that is really important to focus on is whether or not the use of blockchain or the use of decentralization reduces transaction costs, right? Because like if you look at some of these core, some of the core economic principles out there, right? The kind of if you go back to HKUST and all, and that side of things, kind of the whole rationale for having, any type of intermediary is whether that intermediary is reducing transaction costs, right? Hub and spoke versus distributed peer-to-peer networks. The rationale for having hubs and spokes would be, if those hubs and spokes reduce transaction costs relative to, peer-to-peer interaction. So I think it really, when it gets down to it, it's economic cost comparison, right? Are you just doing it for decentralization's sake? Or in the case of some of these DeFi applications, you do see really interesting examples of people using the technology to reduce the cost of transacting in either borrowing and lending or collateralization, collateralized borrowing or whatnot. So a lot of exciting applications of the technology. And I think public blockchains are going to continue to scale over the next 2 to 3 years, and you'll continue to see more and more with ups and downs of the market, of course.
So related to this scalability, so I guess it's like a problem of the success of the blockchain, right? So I think like the other day I was doing like a transaction in Ethereum, and it took me like something like $20 right, to do the transaction. So and this high transaction cost that we may see now, for example, in Ethereum, this is also related to like the ecological cost or electric costs of the blockchain, right? So now maybe Christine, I would like to ask you, what is exactly the problem? Why are transaction costs so high? Is there any future perspective that we may be able to address this to reduce the electricity costs of using the blockchain?
So are you focusing on fees, or are you thinking about the social costs?
Well, I guess they may be related, but I guess like maybe we can start with the question of why are the fees so high right now? Why it's so costly to make transactions in some platforms?
I mean, I think I've got some work in this area, so I'm very very invested in it. So in terms of Bitcoin, we think that there's strategic capacity management, essentially to artificially hike fees. That's sort of where we stand on that. On Ethereum, it seems to be, because it's sort of highest fee first, it seems much more to be a capacity issue. So you see, I don't know, whenever there's a big thing going on or a crash or liquidations or whatever, you see sort of an increase in fees. But there are many blockchains that have very low or no fees. The question is whether or not you can move from Ethereum to those blockchains. And that sort of is where we get into the world of bridges, which potentially are intermediaries who are going to have maybe a huge amount of power, in the sense that they're the ones that stand between two possible blockchains. I mean, I think this sort of goes back to the scalability question. There's a huge number of experiments that are ongoing, either to make existing chains more efficient, or to come up with ecosystems where things can move very freely, and basically just trying to increase throughput and reduce fees. There's probably a minimal level of fees that are consistent with a secure blockchain if it's going to be decentralized, but that is sort of a separate economic question.
So I would like to ask Yanzhen, what is your view on your topic? Do you see like migration from chains with high transaction costs to chains with lower transaction costs? Do you see like this multi-bridging being the future? What do you expect in like 2-3 years?
Yeah, I think just like Christine just mentioned, the scalability issue basically stems from 2 reasons. It's just like the traffic congestion. We have it either because we have too much traffic, or we have very few number of lanes. So the scalability issue basically is because we have limited capacity, but we have ever-growing number of transactions that need to be confirmed and that are waiting to be confirmed to the blockchain. And miners, they are incentivized to pick the transaction that offers the most lucrative transaction fee and to confirm as their priority, because they are profit driven. So they together all these factors push the transaction fee higher and higher. So when it comes to scaling in general, I think there are two major ways of doing it. We can scale the basic layer itself, it's layer 1, or scaling the network by offloading some of the work to another layer, which is the layer 2. Layer 1 is our standard base consensus layer where pretty much all transactions are currently settled. The concept of layer is not an Ethereum or an Ethereum specific concept. Other blockchains such as Bitcoin or Zcash also use it extensively. And layer 2 is just another layer built on top of layer 1. So there are a few important points here. Layer 2 doesn't require any changes in layer 1, so it's easy to make that modification. It can be just built on top of layer 1 that we have, using its existing elements such as smart contract. Layer 2 also leverages the security of layer 1. So by implementing layer 2, we still can enjoy the benefits brought by layer 1 by anchoring its state into layer 1. Ethereum can currently process about like 15 transactions per second, as Ben just mentioned, on its base layer. And layer 2 scaling can dramatically increase that number. Depending on the solution we are talking about, the number can be about like 2,000 to 4,000 transactions per second. We are talking about a drastic change.
So if we think, for example, about Visa being able to transact thousands of to process thousands of transactions per second, you think that layer 2 solutions will get us there eventually?
I think so, especially if we have if we can have a large quantity of transaction dedicated to the off-chain, and only just taking the Lightning Network as an example, we can reduce thousands of transactions into just 2 transactions, which is opening of the channel and closing channel. And in that case, being able to have a transaction throughput comparable to Visa is possible.
Yeah, and building on Professor Chen is going on there. I think it's only going to get better over the next 2 years or so, right? And I think one of the biggest events over the next 1 to 2 years is definitely the Ethereum 2.0 upgrade, or no longer called Ethereum 2.0, right? But if you dig into the details of that upgrade, right? Like I think it's all about scalability, right? I think the mainstream news reporting of it say, okay, it's the move from proof of work to proof of stake because that makes sense, and it's more energy efficient, which is good. But actually, a lot of the underlying changes that are being made to the Ethereum blockchain are essentially being done to enable future scalability, right? So like we get into the details of how the tech is working, they're kind of trying to move to this modular approach, like a modular architecture approach, where if you look at the Ethereum blockchain right now, how it works, it's very monolithic, which means that basically all transactions and everything basically use the same chain. But as you go into the future, like Ethereum's basically redesigning itself so that only certain types of data and certain types of transactions use the main chain, and other transactions can use kind of like a data availability layer is what they call it, and then kind of the layer 2s as Professor Chen was talking about, can scale even more, right? You can have additional layer 2s and shards and all these different things. So I personally think it's only going to get better over the next 2 to 3 years. Public blockchain scalability, that is.
I totally agree.
That sounds interesting. So I wanted to comment on a related topic. So first, I wanted to ask Anthony if he had anything to add about that. And the second question I wanted to ask him is, the first, I guess, consensus mechanism was proof of work, right? And we saw the energy costs going up, and then we started saying now it's consuming the electricity of Switzerland, then of Sweden, then of Italy, right? So will we see an improvement in the energy consumption as we change to different consensus mechanism, or what is your view?
I'll mostly punt on this. I'm not an expert on the consensus kind of stuff at all. I guess like the only things like from my perspective as using these things a bit, sort of, I guess there's two perspectives. One is basically how does it feel like from a user's perspective? The second is socially how much is wasted, right? From a user perspective, I mean, Ethereum is like ridiculously sort of overpriced at the moment, right? But if you use like Avalanche, Solana, sort of your L2s or stuff, you can do swaps like on Avalanche for like $1 or so. You can do cents for like 10 cents. On Solana, you can do it for like well under a cent when it's up, which is not all the time. But the thing is that sort of like the fees on these things are already well in the range of basically sort of normal human beings can like play around with these, and sort of the transaction fees are not like unviable, right? So then the thing is like, if you use Avalanche or Solana, like it feels like very smooth relative to traditional finance. You're paying like maybe 10 cents $1 fees. Transactions go through in like seconds, and then boom, you're done, right? So I feel like from a user perspective, this is smoother than I think most people's impression are, where they sort of have this impression in the past of Bitcoin taking like hours to send and costing like tons of money. Now the social cost, I won't comment so much on that as sort of, I'm not an expert on that. Like, I think that's the other issue, which is like Bitcoin sort of, it costs not that much to send Bitcoins around, but most of it is like the newly printed Bitcoin is burning a ton of electricity, right? I think like hopefully the transition of Ethereum to proof of stake sort of helps that a bit. Bitcoin, it doesn't seem there is much hope of, or like my understanding is there is not much of an effort to push that in any direction other than sort of continuing proof of work. So sort of, I guess I'm not super optimistic in the short run of sort of Bitcoin losing dominance or sort of maintaining dominance, but moving away from a very wasteful proof of work model. So I think like good for users, potentially still bad for society for quite a while. Yeah.
So I don't know if any of our panelists wants to add to this topic. Otherwise, I guess I would like to move on and ask you questions related to anonymity preservation, security, consumer protection. So when you hear regulators talk about crypto, one of the first things that they mention is these concerns about criminal use, ransomware, money laundering, hacking. So are these concerns serious, and what can be done about them? So, Christine?
Oh, I don't have a solution to that question. I have no idea what can be done. Yeah, I mean, it's pretty clear that regulators are really upset about some of these issues. I think where they've been extremely successful is with fiat off-ramps. If you want to get cash and buy bananas, you have to pretty much let people know who you are. The sort of general ecosystem makes it very difficult to track. I think, I mean, this is sort of the regulatory shoe that's going to drop. I think regulators and sort of international banking system, basically, they're really pushing hard for some sort of controls, and where it's unclear to me exactly how it's going to go, just because regulators don't quite seem to know what the ecosystem actually is all about. And different countries seem to be taking very, very different approaches. But this is, I think for crypto to grow, this is something that has to be sorted out. And regulatory uncertainty is actually a pretty big impediment at the moment, I'd say. So I have no solution. I agree with you that it's a problem.
So following up on this topic, like, so for example, traditional payment systems, you can think like credit cards, right? They just not allow you to do transaction payments, but they offer some type of insurance or fraud protection, right? So do we have anything similar in crypto? For example, when we do transactions? I guess I can ask this question to Yanzhen.
Yeah, I think with the recent development of DeFi, it is possible to do some this type of financial services on crypto world. For example, the lending and borrowing, and also margin trade with the similar level of insurance and fraud protection that traditional financial services do. For example, taking the land and borrowing service as an example, let's say that person A wants to earn interest on his coins, while person B wants to borrow some coins. So person A goes to Compound or AV, which are two platforms that allow for crypto borrowing and lending. Person A can deposit his coins into a smart contract. In turn, he gets what he gets are called either C tokens or A tokens, depends on which platform he uses, that are a representation of his original coins plus interest. Whenever he wants to, he can just turn his A tokens or C tokens into that smart contract that was created by Compound or AV, and they split out his original deposit plus interest. Now the smart contract is created so that there's no human being that has to do the calculation. It's all automatically done by code so that it solves person A wanting to earn interest by lending in a traditional way. So when borrowing coins, person B must do something we call over collateralized his loan. So this means if he wants to borrow $100, he must put more than that for, like, say $110, so that if he runs away and never pays back his loan, the smart contract is written in a way that it can pay person A his or her coins plus the interest. Another service that is possible right now is margin trade. Margin trade is also can be done through DeFi. So essentially what margin is it is a loan that will automatically sell your stock if the stock goes below your down payment. To trade on margin, the investors usually need to be able to prove who they are, along with having a minimum of a few $1,000s to even have access to margin trading. The fees are usually not cheap, and with decentralized finance, margin trading can be a lot quicker, and it's open to anyone in the world with money, and it's a lot safer as well.
I guess I will.
Marc, could I jump in and add a bit on this question?
So
I guess, like, here's a question I want to raise. Is it clear that the status quo we have in TradFi is good for consumers? And what I mean by that is, like, we feel kind of good, which is you buy something with a credit card and you have nice, like, purchase protection and something. But if you ask, like, the entire US, say, to say, like, look, we'll give you purchase protection on everything you buy, but you pay 3% more for literally everything you buy, right? Sort of somebody's paying for this stuff, right? And it's like sort of, it's not, I think, totally salient, like what the sort of counterfactual would be in a world where we had no protection, but sort of just uniformly lower prices as a result of basically no protection, right? Is it obvious that we should be buying insurance on like $3 purchases? This stuff diversifies out when you're making a lot of $3 purchases, right? So I mean, at some level, I feel like these like new institutions cast some kind of questions on our classic institutions on like, we could have gone another way, like, maybe this other way sort of ends up being better for consumers, that we just get used to the fact that sometimes we get scammed, and for small amounts of money, like, that's okay, and we just diversify it rather than having protection on everything, right? So I feel like at some level, there's a bit of healthy institutional competition coming from crypto, where sort of we start history again, run things totally differently, see the institutions that emerge, and we get to see like, maybe we find a different path that like works better. And I think it's like not always salient, like, what the problems are and whether it is that the current institutions we see in TradFi are close to optimal for consumers. So I think my take is it's not so clear that the things which feel good to us as consumers in general equilibrium are actually good for consumer welfare overall.
Yeah, that's a very interesting point of view. I think I never heard this view before. So coming back though to this question, so I guess like Yanzhen before mentioned like these over-collateralized loans, right? And one of the reasons, for example, we have over-collateralized loans is because, I think, and correct me if I'm wrong, is that we have some problem enforcing the contracts outside of the crypto space, right? So will there be some way to have like crypto contracts or crypto agreements, for example, that are like uncollateralized loans, but that we can enforce outside of the crypto space and bring to kind of the, I don't know, the traditional economy? Or, for example, how can we enforce things like ownership rights or property rights, I don't know, to an NFT, for example? So these type of questions, I don't know if, Ben, you have any view.
Yeah, no, I think just going back to kind of the points that Anthony was going through right there, I think there's definitely a lot of hidden costs to intermediation that tend to go unlooked at, right? And I think it's always a trade-off between service A and service B, and in which you feel more comfortable with, right? Like so for example, if you use, you look at what's happening in the markets, you look at what's happening in the markets today around, like a decentralized stablecoin, right? I mean, basically you have, you kind of have two approaches to using a digital dollar, if you will, right? Like one approach is something that's fiat collateralized, and the other approach is, something that maintains a peg in a programmatic way, right? And I think in theory, the idea should be that, okay, if you look at, a fiat collateralized stablecoin, there's additional costs because you have to, so several points here, right? It's like, okay, what are the costs of using the dollar for transactions, right? Sending a payment from me to using the dollar. Well, you have to use SWIFT, and then there's bank wire transfers, and then, and then there's time costs. So, if you use a digital dollar, something like, USDC or USDT or whatever, or UST, the on-chain, assuming the on-chain transaction costs were lower than wire transfer costs, right? That should be a benefit to using the asset for payments. I think when you look at the hidden costs in all of this, they're definitely very, very nuanced. For fiat collateralized stablecoin, maybe people don't know, like most of the people or most of the companies that are responsible for issuing that, they have to store their assets at a trustee, and then there's audits, and there's a lot of kind of a lot of overhead, and there's also a lot of compliance overhead, right? So at the end of the day, those costs have to somehow get factored back into the users, right? And that might be through when you want to redeem whatever that fiat collateralized stablecoin back into USD for some reason, maybe that's where the cost hits you. So you had the rise of some of these other approaches, right? Algorithmic stablecoins where the peg, if you will, is not done by underlying assets, but it's done by some complex math and things like that, complex mechanism. And people might say, okay, well, this my on-chain transaction costs are lower than wire transfers. That's good. B, if I want to redeem back and forth between this asset and other assets, oh, it's less expensive than the fiat collateralized one. Great, I'm going to use this, right? But there's no free lunch, right? So you have to really kind of, because the space is so new and experimental, you really have to kind of understand where the risks are, and act accordingly, right? It's not, a lot of things are not as straightforward as they seem. But yeah, I totally agree with Anthony that sometimes there's a lot of hidden costs, and you gotta kind of pick through the details.
So I guess related to these hidden costs and all this experimentation going on, right? So this kind of goes into question, what about regulation, right? And here, I guess, the first question I had is we already have existing regulation for financial markets and products, right? So is the question about applying existing regulation just to these new assets, or do we need some specific type of regulation for the crypto space? Maybe Christine, you could give us your take.
I think translating existing regulation, and I'm most familiar with the US framework, to the crypto space is somewhat problematic. So, you know, if you try to compare the set of regulations around trading systems that we have in the US and compare it to an AMM, it's just not going to work. It just doesn't make sense. And one of the biggest challenges, I guess, for regulators is there's a tendency to backstop institutions because we worry that people are going to lose their money, and we worry about this, that. They're very leery of sort of bankruptcy of large financial intermediaries. In DeFi, you know, one of the disciplining devices where people essentially find out whether or not code is buggy is by very, very large exploits where huge amounts of money get removed from a bad protocol. Regulators, I think, naturally just view that as being horrific, but actually that's just the way the system is policed. So it requires, I think, a different way of sort of thinking about what the role of our social constructs are in that space. And that's something that's, I think, going to be a really difficult conversation.
So, Yanzhen, what's your view on this topic?
Yeah, I'm not an expert in this field, but I did some research. I found that the regulatory framework of the United States is largely depends on federal regulators, and those currently involved with cryptocurrency regulation are SEC and also Commodity Futures Trading Commission, CFTC. So alongside specific state regulators who prefer acts specifically to each state. In general, the CFTC oversees cryptocurrency futures and the spot market, and SEC monitors developing cryptocurrencies such as the initial coin offerings. So even with the reputed firm's grip of the SEC and CFTC on the financial market, the regulation on cryptocurrency are still quite flimsy and also contradictory. The SEC has stated that it views cryptocurrency as a security, while the CFTC considers it as a commodity. So state regulators also have different stance on the nature of cryptocurrency that colors their regulation and per state, yeah.
So, Anthony, so we have seen around the world different approaches, right? So we had the mining ban in mainland China of Bitcoins, right? We had the adoption of the Lightning Network in El Salvador, right? So there are many different approaches. Where are we going as maybe as a world, or are we going towards more or less like same unified approach? Are we going towards different approaches? And if so, what do you think will be a good approach that is implemented or that should be implemented, and what is a bad approach to crypto?
So I have a slightly science fiction kind of view, so this is very speculative. But here's kind of my view. I think that basically you can think of crypto as basically a technology that allows you to enter into sort of financial and other contracts without relying on the government and the legal system to enforce them, right? And I think that basically governments and legal systems have reason to be very unhappy about this, because basically sort of much of their power, much of their capacity comes from the fact that they are a monopoly on violence. And so I think that sort of, I view it as there's going to be a kind of bipolar evolution of this space where sort of control over contracting and the financial system, the ability to discretionarily cancel contracts, dump a bunch of money into the system, so on, is so valuable for those countries that have the state capacity to control finance, that I think these countries that have developed financial systems built on top of their developed functional legal systems like the US and China are going to crack down on this stuff. Sort of regardless of whether it's good or bad for society, they have the political economy, I think, is like makes it very difficult for them to not eventually come down on this stuff. China has done it already. It feels like the US, to the extent it has the state capacity to do so, will trend in that direction. Now, I think the rest of the world, the problem is that sort of crypto is a substitute for courts as an enforcement mechanism. And the thing is, it's precisely in those countries that don't have the state capacity to really counter this, even if they try, that I think sort of this stuff will really take off and replace like people, like what is, I think, magical about crypto is that sort of using decentralized finance, terrorists can trade interest rate swaps. Is that a good thing for the world? Who knows? But the thing is, that's a thing that they can now do, right? And so I see this bipolar evolution where basically half of the world with high state capacity will do their best to fight this, to maintain their monopoly on violence. The other half with less state capacity will not be able to prevent it from taking over large fractions of their systems. And then so is that a good state for the world? I am not sure whatsoever. But I think that sort of, it feels to me that that seems like the direction the world is trending, that there's gonna be complex on-chain contracting activity in areas of the world which previously did not have developed enough court and legal systems to even write regular contracts. And so I find this bifurcation very interesting. Should we go in this direction? That's another question that sort of I don't think I have a good answer to whatsoever. Yeah, but that's a science fiction kind of view of what I think is going to happen.
No, and I think it is a fair point, right? And I think maybe just you know, going down the philosophical route a little bit here, right? Like I think anytime you have an emerging technology or some type of technology that changes the game a little bit, it does bump up very heavily into established interest, right? Like, you know, going way back in time, right? You go to the printing press, for example, right? That allowed for the dissemination of information in a much faster and decentralized way, which really kind of bumped up against like the established like top-down, you know, information dissemination structures of, you know, the church and all these things in Europe at the time, right? So you have that with the printing press, and you have it with other technologies, right? With the IT boom in the, you know, in the 60s and 70s and 80s, you know, it led to, you know, in the 90s, kind of the U.S. government was looking at, oh, how do we regulate this? And then there was regulation, I think, in the late 90s, which eventually got, you know, there was fight back against that. So you know, I think it's par for the course, right? You know, technology is evolving, people are finding new tools for doing things in more effective ways, and it, you know, bumps up against the establishment.
We are almost close to the end of the panel discussion, so I guess I will ask Christine and Yanzhen, what is your view on this topic, or if you want to add something to this last question?
As a finance guy, I absolutely never try and predict the future.
Yanzhen?
Yeah, I think that it's hard to say. In the coming year, there will be in the coming years there will be continual talks and efforts that directed towards the regulation of cryptocurrency. And some efforts are already going into making crypto assets available on the traditional financial and security trading platforms such as NASDAQ. This is seen in the Bitcoin ETF debut on the New York Stock Exchange, as well as the Toronto Stock Exchange, allowing a more conventional means to invest in crypto. While there are still roadblocks, such as the fact that ETFs do not hold Bitcoin directly, but Bitcoin future contracts, making it less liable to track Bitcoin's price directly. A problem like this, it provides a simpler approach for investors to interact with cryptocurrency on their conventional security trading platform. So, and there are a recent increase in knowledge and exposure to other cryptocurrency, crypto assets, for example, non-fungible tokens. And it's a plus to the application of cryptocurrency. So with time, more applications may surface across several other industries, improving the real world usage of cryptocurrency greatly.
So thank you very much. So now let's look at the questions that we have in chat. I think you can see them if you click the Q&A panel below. So I will read them. So somebody, so Kenny is asking us, digital currencies are a complementary form of cash. Will it be possible to finally replace cash and have digital cash? I guess this may be related also like to CBDCs that sometimes are called digital cash, right? But maybe instead of CBDCs, we can have private digital cash. I don't know what is your view. So I guess who would like to ask to respond?
Yeah, I mean, maybe I can just say a few words just quickly, right? Like, will digital currencies replace cash? I think it's a little bit of a. The question is kind of like, you know, grouped up in a bunch of different concepts, but you know, I think digital currencies, there's many different types of digital currencies, right? Will Bitcoin replace cash? I think currently it hasn't, right? It has volatility. Will central bank digital currencies replace cash? Possibly. And you know, you've got, I mean, but the question is like, how long will that take to get out there, right? And you know, if you look at a place like the United States, for example, I mean, it's basically, you know, the whole ACH system and like payments infrastructure is quite you know, quite slow. I mean, the Fed has other programs that are designed to speed that up. Like I think it's called like Fed Now and some other things like that. So yeah, will digital currencies replace cash? I mean, I think it's hard to say. I mean, I think other like newer infrastructure might create, you know, other digital forms of cash. But yeah, I don't know if any of the other panelists have thoughts.
So in the US, there have been some peer-to-peer payment solutions that are pretty much instantaneous. And so effectively, it's bank money that flows from phone number to phone number. So as far as the consumer is concerned, once you have those kinds of solutions, whatever the rails are doesn't really matter because it all kind of looks good. I think that the legacy systems are effectively have something that looks a lot like a digital solution, even though they're not, if that makes sense.
So another question that we receive is, what is a stable coin and how can we benefit from them?
Yeah, so a stable coin is to address the volatility of cryptocurrencies. We all know that the price of a cryptocurrency can change drastically within a short period of time. With stable coin, we can worry less about its value, and the stable coin makes it possible if we want to design multiple new financial assets in DeFi, because with stablecoin we don't need to convert between cryptocurrency and fiat every single time when we make a transaction. Instead, we can convert cryptocurrencies with stablecoins, and in that case, the conversion can be cheaper and faster. It can really empower DeFi services.
I ask you. Oh, go ahead, Anthony.
Oh, sorry. I'll just maybe add on a bit to that. I think my view is that an interesting innovation of stablecoins is that take US dollar stablecoins, right? It makes it, I think, possible or easier to trade assets that are pegged to US dollars that aren't eventually in pipes and systems that if the US government really wanted to, they could find your US dollar stuff and freeze it, right? That seems an interesting innovation because sort of as we see in the Russian situation and whatever, sort of at the end, if you hold like foreign denominated assets, right, you're using someone else's pipes and you get on the bad side of them, they freeze that. I mean, is that good for the world? Potentially, but they do that. I think like stablecoins potentially change that. Now it's possible to hold like, so for the crypto collateralized stablecoins, stuff which is worth a US dollar, that even if the US government doesn't like you, you can hold the thing. So sort of, I think that sort of for people who are not necessarily sort of people we want to be able to do this, that's potentially a useful innovation. I think that an interesting tension, it feels to me, is that sort of whether the US is happy about this or not is actually unclear. Foreign policy is potentially unhappy because their ability to freeze US dollar assets as a kind of like policy tool is limited. Treasury is potentially happy because like the demand for US dollar denominated assets, which ultimately pushes down US yields and contributes to exorbitant privilege, potentially is expanded if the technology for holding like coins in a way that the US government can commit not to be able to do anything about increases. So I feel like there's this interesting tension that sort of you can hold US dollar stuff that the US government can't stop you from doing with this technology.
It's a very interesting point. So actually, I started asking you about stablecoins because we have a lot of questions in chat about what happened to UST and whether we are in the middle of a panic, right? So, and UST, as some of you may know, it's a type of algorithmic stablecoin, right? So I would like to ask Ben, could you give us an overview about what happened and what is the industry view about what's going on currently in the crypto market?
Yeah, sure. No, it's the hot topic of today, right? It's not a simple issue to go through, but right, and in a nutshell, right, essentially, as I mentioned earlier in this conversation, right, like the approach to stablecoins is, there's two approaches, right? One is the fully collateralized approach, which is, your USDT and your USDC of the world, where you have a centralized issuer, and that centralized issuer collects USD via wire transfers, and then they tokenize that underlying asset on the blockchain, and then that blockchain-based asset, that token, can now be freely tradable on blockchain for faster settlement and cheaper transaction costs. So those are the fiat collateralized stablecoin flavors. More recently, folks have, because in the crypto space, there's a huge emphasis on, as Anthony has mentioned, right, on decentralization, right? Like, how do you avoid potential central points of failure around like administrators, like central administrators, right? So I think there's philosophically, there's been a push towards kind of this concept of algorithmic stable coins, which Terra USD, otherwise known as UST, is one of which. And these are stable coins where there is no centralized, there's no centralized issuer, right? It's not collateralized by anything. The way the peg works, so obviously an obvious question would come, okay, well, if you don't have underlying assets, how do you maintain a peg? In the case of UST, the way it works is it's almost like an arbitrage fueled peg, right? So the way it works is like you basically have two assets. You have UST, you have the stable coin, and then you have Luna, which is this separate native token. And kind of the on-ramp into this ecosystem is like essentially, if you have $1 worth of Luna, you could mint that into $1 of UST, right? So kind of the way that flow works is, let's say you have $1 US, you use it to buy $1 US worth of Luna, and then you can kind of mint it into UST. And then the way that system works is they basically the way the mechanism works is they also redeem in the opposite direction. So if you have $1 worth of UST, you can redeem that back. If you have $1 worth of $1 worth of UST, you can redeem it back, and you can redeem it back into Luna, and then that Luna gets minted. So anyway, so you have these two different competing tokens, and essentially what's happened over the past few days is, there's a lot of rumors going on in the market, but kind of similar to FX speculators and FX traders, there's those rumors out there that someone took a large position and then has essentially tried to break the peg by taking large positions and then making a few trades, and then what that kind of resulted in a few days ago is this peg starts to detach from 1 to 1. And then there's panic in the market. People start saying, oh, okay, is my UST still going to be worth $1? And then that fuels people wanting to take that UST out of the system. So taking it out of the system basically entails there's different ways you can take it out of the system. One is that you could sell it on an exchange, right? You could sell that UST for back into USDT or whatever asset. And so that's a selling pressure, right? So that inherent exit from the system is a selling pressure, right? You have that feedback loop going on. And then in addition to that, what people can also do is people can also they can also use that market mechanism, kind of that market rate exchange mechanism that I touched on earlier, where they could take that UST and they could basically kind of exchange it back into Luna at this $1 rate, right? So if you think about like what's happening in the market right now, is you have a bunch of arbitrageurs who are essentially going into the markets, buying UST at this below $1 rate, and going to this market rate mechanism, kind of exchanging it at that higher rate, and so they get back Luna and they essentially just sell it, right? So that's this additional selling pressure. So long story short, right? I think for people who are who originally intended to hold UST for its stability benefits, like obviously people are a little bit people are worried about this. What does it mean? And I think, but behind the scenes, there's a lot of work to try to bring stability to this. I'm not sure how it's going to play out, but as I mentioned earlier, like this whole cryptocurrencies in general, like there's still a lot of experimentation in terms of like the incentives, like the economics and the technology. So for people who are interested in getting involved, right, you have to be careful with how much money you're putting in, and if you do decide to put a lot of money in, you have to kind of understand what you're dealing with and the risks before you go in, right? So yeah, and long story short, that's kind of how things have been playing out. I'm not sure how it's going to play out, but yeah, it's currently happening as we speak right now.
So what is the view of our other panelists? I guess many of you will have many things to add or to comment about the current developments.
I think it's this is not the first algorithmic stablecoin that's had a sort of little bit of a bumpy ride. I mean, Fei, which was sort of had a different equilibration mechanism. I think they were using one of the automated market makers and some sort of clever liquidity strategy to keep the peg, but still it had trouble, and they had to sort of move in. And I think this is just it's actually it's an interesting ping pong game. So you have very clever people setting up these really complex systems where they think they've understood all the incentives, and then you have people who are basically recreationally trying to find holes in those incentives. I think the good news is that probably the stable coin that emerges that is algorithmic and that is in fact stable will be really robust. And that I'm looking forward to.
Then Anthony, I don't know if you want to add something to it. Otherwise, I get related to that. This morning when I woke up, I checked the prices, right? And I saw coins falling between 10–20%. So even though this started with UST, I guess the question is, are we going to see a panic developing right now? Yanzhen?
Oh,
It's a tricky question.
no, I was thinking right now in the market, the speculative investors, there are a lot of speculative investors, and the price definitely fluctuates a lot. Yeah, and there are also like beyond this fluctuation problem, there's also liquidity problem. For example, for the NFTs, although we can see that some of the tokens are sold at a astronomical number, but it doesn't mean that whenever somebody wants to sell it, there's a buyer ready to pay that amount of money. And so liquidity is also another issue that that bothers investors.
I guess, yeah, on my side, so I'm definitely not going to try and tell you where crypto prices are going to go. I don't sort of, I'm a finance professor, I don't give investing advice. I think that sort of one thing though that I've been kind of happy with, I mean, like, look, of course, crazy sentiment swings like drive most price movements in these markets. I mean, more so in crypto, but look, GameStop happened, like markets do this, right? But I feel like there's kind of the sentiment driven insane moves and the tech, right? And I guess one thing that like I find pretty interesting and I think still inspirational in what's looking like a crypto winter developing is like, hey, the tech held up decently well. Like stuff rose, gas fees were high, some stuff broke, but a lot of the basic infra like is pretty robust to like pretty big market movements. Not necessarily less robust than systems we have in TradFi, like flash crashes, stuff like that necessitate like hitting the stop button and rolling back trades, right? So it's like this stuff has been, I think, like exactly as Christine said about sort of stable coins, right? Like in real time, this stuff is just getting hammered by the combined sort of intellectual power of like tons of like black hat hackers as well as sentiment driven like insane booms. And every winter makes the tech improve. So, I mean, it feels to me it's already fairly good and robust and only getting better every winter. So I think that like, look, like I am not very happy about how the crypto part of my portfolio is doing, but I'm optimistic in the long run about the tech, I think, yeah.
Reading other questions that we have from the public. Euron mentions Elon Musk once sent 2 tweets and causing the price of Dogecoin to rise and then to fall. So what does it mean that we observe the prices of cryptocurrencies fluctuating so much depending on what one person says? And I guess if I can summarize, I would say, what does it tell us about like the fundamental value versus possible like bubble value that some cryptocurrencies may have, that the tweets of one person can make them change so much? Maybe Christine?
Yeah, so I mean, rational expectations, which is sort of the thing that most people sort of think about when we sort of think about what prices should be. I buy something today because I think that, you know, I'm going to be sensible about what I can sell it for tomorrow. If I think that everyone is lunatic and they're going to, you know, buy it for $500 more, then it's perfectly rational for me to also impound that into what I'm willing to pay today. So I guess the point that I'm making is bubbles are not necessarily inconsistent with what we think of as rational pricing and rational people participating. You just have to be aware that there are 2 components. There is a fundamental component and then a bubble component. And I would think that even though Elon Musk is a successful entrepreneur, I would think that his tweets fit into the bubble component. But yeah, I mean, if everyone takes them seriously, okay. You know, Beanie Babies. I don't know if anyone remembers those things. This was a source of great value. I mean, really? So, yeah, that's the joy of markets.
I see that Ben is nodding, so maybe you want to add something?
Maybe he collected Beanie Babies.
Yeah, I remember. No, I remember that trend, right? It's all about, it's all, you know, it's a lot of it is, I mean, if you go back to it, like from behavioral economic point of view, right? It's all, there's such a strong, I mean, especially in the crypto market, it's very, very sentiment led, and there's a lot of herd behavior. And, you know, when you have an asset, I mean, I don't think there's been an asset. I mean, maybe, I mean, it's an overused, you know, comparison, right? Like the whole tool comparison, but like, you know, what is the intrinsic value of some of these things, right? Is a lot of it is belief led. A lot of it is looking at what else is investing in, what everyone else is investing in, and it also a contributing factor is definitely all the free money that's been floating around, right? Like when you have, you know, such a huge amount of liquidity in the system, right? People tend to take bigger risks, and there's, you know, there's more money floating around to inflate assets. So I think I think this issue isn't just like, it's not just like limited to, cryptocurrencies as an asset class. Like I think you see it in a lot of asset classes, right? Like, real estate, tech stocks and all of that, right? Like even if you look at some of the companies that have IPO'd in the last year or so, there's been huge destruction of some of the market value of some of these companies. So like I think like beliefs in the future, because the future is so uncertain, like beliefs in the future which drive market value can definitely be subject to different perspectives and influencers saying things are going to be this way or things are going to be that way. So yeah, go back and read Irrational Exuberance from from Professor Schiller, right? So a lot of these things are always going to be with us as a society.
Next question. Jin Yuki asks, what do you think about projects, for example, the play to earn project? So I guess this is related to the gamification of cryptocurrencies, right? What is the future of this type of projects or of this type of business? I don't know if you have any insight. So maybe Yanzhen?
I have seen this business model with the metaverse related games, but this is really not a very new concept. With the traditional game, we also have some have this type of profession. We have people who try to play and try to like build on their character and later try to sell their avatar or account on a different platform. It's just without the infrastructure before, it's not very easy to monetize their account. And now with the new infrastructure, this industry can become more and more popular, and it can become a large labor market for young people.
Maybe I'll jump in also out of it. Totally agree. Totally agree with Yanzhen that look, gold farming has been around as long as MMOs have been around. This is like really not new. I'm like even more pessimistic, I think. I think the idea that basically like people can make a good living playing games, like there are two possibilities. Either people don't make a living or the game becomes sufficiently unfun that it's basically work. And this is just compensating differentials, right? I mean, if something is sort of sufficiently fun, people compete down the wage that they get from playing it until like you're either poor or it's not fun anymore doing it. So I don't think like crypto has changed the basic economics of this. What I think is like a bit different about play to earn and how crypto changes the dynamic here slightly is I think that sort of US regulation makes it hard to basically take all of your early like RuneScape players and say, now you are RuneScape owners and you have equity, because you need them to sign all kinds of like, you need them to be accredited and safes are hard and stuff like that, right? And the lowered cost of issuing equity means that you can take your early users and you can airdrop to them equity, which gives them cash flow rights, some governance stake, or I mean like sort of depending on how you set it up, sort of some stake in the future of the platform. I think this is a thing that changes the economics a bit. Like for a platform with like network effects, sort of having the early users really invested and having some stake in the future of the platform can really change the future of the platform. So I think that's sort of, I'm pessimistic about sort of pay your users, but I'm optimistic about sort of a technology that makes it easier to make your early users stakeholders economically and in terms of governance in the future of the platform. Yeah, I think there's a number of papers in finance that have basically made this point, that sort of giving equity to early platform users is a pretty valuable thing to do. Yeah.
Yeah, so maybe somewhat related, not exactly the play to earn, but in the case of some NFTs, they are related to either games or, related to games or collections, right? So what I was thinking is like when I was a teenager, I was collecting like these Pokemon cards, right? So are NFTs kind of bridging this gap of collectibles? But now if you have like these digital assets, right? without the blockchain, you will be dependent on the company or the company or the game that is issuing this collectible, right? So I'm correct to saying like NFTs allow you to keep kind of like these items or collectibles, even if the company fails, for example. Is this the appeal? So maybe Ben?
Yeah, I think as mentioned earlier in this panel, right? Like I think the great thing about blockchain technologies and crypto technologies in general is you're able to have this new infrastructure for issuing and protecting all different types of assets. In some cases, those are digital currencies. In some cases, those are social currencies, and in some cases, those are NFTs, right? And the only distinction between an NFT and these other currencies is the fact that it's non-fungible, right? It's representing some type of unique asset, one of a kind or several of the same kind. So, like I think what's been cool about the NFT boom is it's kind of the first. I mean, out of the entire time that I've been in crypto, I mean, the first time that I've seen actually people really start to talk about. People from the mainstream really start to talk about this has been with NFTs, right? And you have to. It's definitely like a consumer push, right? Whether it's cards or pictures or whatever. I mean, these are things that touch people's daily lives, right? So I think NFTs are quite interesting from that perspective of helping to increase adoption. I mean, there's a lot of strange things going out there. Some of them interesting, some of them scammy. But yeah, it's a pretty interesting space. I mean, the only thing I'll just mention on NFTs as a last point is, I think a lot of people have talked about them in the context of it being used for different in-game items and for for profile pictures and things like that, for different digital collectibles, as you mentioned. But actually, that technology, I mean, many different things are also NFTs, right? Like for example, real estate, like a house can be an NFT, obviously a piece of art. Any type of unique assets. I mean, for my company and like some of the projects we've experimented on, like we've actually seen, it's actually kind of a funny use case, but we've seen cases where actually like physical livestock, like biological assets can also be represented, technologically as an NFT, because you have unique data and unique metadata associated with that physical object. And you can use different things to represent it, right? So in the case like profile pictures, some of the traits or unique characteristics could be funny things like a hat or clothes. But in the instance of like a physical object, let's say livestock, whether cattle, for example, like you represent different these different physical animals through different defining physical characteristics, weight, age, whether or not certain ones have been vaccinated. So yeah, I think there's a lot of use cases out of it, and in kind of the the B2C world, but also in the B2B world.
So thank you, Ben. So now I'm looking at the time and I see that we are 1 minute to 11. So I guess I will say, is any of the panelists that want to add to this last question about NFTs and or share their thoughts with us?
Just to briefly comment on Ben's use case on livestock. If it's an NFT, I can now buy a fractional share of whatever that happens to be. And so that gives liquidity to livestock in a financial way, which is pretty astounding.
Yanzhen, you wanted to add something?
Yeah, so since NFT is separate from the digital art or video or twist, whatever that it represents, NFT itself is just a certification of ownership. So it is true that even if the company failed, we still own that. We still have that record on the blockchain. But if the company already failed, what would be the value of the underlying digital art? So owning that may have little value for the investor, and also due to the same reason, the separation between ownership and the art itself also promotes the work, I think, because NFT doesn't stop sharing. And NFT actually proves ownership as well as promoting sharing at the same time. We can, for example, we can hold Neon Cat while still like share Neon Cat on YouTube, on Snapchat, anywhere. And trading an NFT can only make Neon Cat more and more popular.
Could I maybe add one small thought just to Yanzhen's thought? I feel like one thing that is cool with NFT representations of in-game items, forking state is a lot easier. Say in the World of Warcraft, right? Developers make a decision everyone is unhappy about. If everything in the game is an NFT, the whole community can say, screw those guys. We're going to take all our items, build a new game, and play that instead. So I feel like the idea of like everything in the game being just forkable makes it possible to just create parallel universes in game design, sort of in a way that's like very difficult to do now, where state is like kept within the game companies. So I think that's potentially an interesting thing that could happen in that direction.
That's actually very interesting. So I guess with Anthony's intervention, we can finish today's talk. Thank you very much to the panelists and the public for coming. And I guess I will just remind you that next week we have another talk about digital assets, this time with about central bank digital currencies, where we will have Barry Eichengreen and Yong Chia that will be talking about the future of CBDCs. So you are all invited to join us. Thank you very much for coming today.